for being here with us. I'm going to introduce our esteemed panel. Panelists, when you hear me call out your name, just give a wave. We are joined here today by Karen Gonin of Green Team New Jersey Realty, as well as Green Team Home Selling System. That means Karen is licensed in both New York and New Jersey. Welcome, Karen. We're also lucky enough to be joined by PJ Keelin of Family First Funding. PJ is the branch manager of the Warwick location. Welcome, PJ. Thanks for being here. And also Jeff Lobb from SparkTank Media. Jeff, we're thrilled to have you here as well.
Thank you.
Jeff is a marketing guru of sorts for the real estate industry, very well experienced, and we're going to have a great discussion with him at the tail end of this meeting here about the future of real estate service providers such as realtors and whatnot. And last but not least, Melissa Brzett, the brains behind the housing market update. She is the marketing director for the Green Team. Welcome, Melissa, and thanks for being here. Okay, so without further ado, I'm going to jump right in here, share my screen, and we're going to take a look at our update and from a statistics standpoint. So we're going to start out with some national statistics first. This is basically a look at, total home sales, the pure number of homes that are selling. And I always say that this is the mother's milk of all statistics for the real estate industry. It's just all about how many homes are selling. And you can see that, 18 nationally versus 17 has been down a tick for the last 2 months, and was kind of dead even early on. And really, we're seeing a mixed bag of results. That's basically the long and the short. We're not necessarily seeing a continued trend of more homes year over year. The word on the street is that it's all about inventory. There's not enough homes to sell. There's buyers stacked up on top of each other looking for homes. We're going to talk a little bit more about that in a second. Here's another look at pending home sales too. This is interesting, this chart over here on the right. Creeping lower, it seems. You can see there's peaks and valleys as you go through each year, but it looks like we're trending downward on pending home sales from a national standpoint. So here's yet another analytic to look at, is year-over-year inventory levels. All of these statistics, by the way, come from the National Association of Realtors. For the first time in 36 months, year-over-year inventory levels are up. So that's something, but also, so maybe that's a good sign, but also maybe that's another sign that maybe the market really is slowing here a little bit, truthfully. However, here is one that shows the opposite view, which is foot traffic. All right, this is an indicator of future sales. This shows purely the number of people that are in homes taking a look, trying to buy, so on and so forth. And you can see the light blue 2018 versus the dark blue 2017 up consistently all year. So foot traffic is up. Sales are, arguably down on a national level. So I think all in all, from a national perspective, it's still a very solid market. I don't think we're looking at a precipitous decline by any stretch of the imagination. Another thing to look at, which could ultimately continue to fuel things, is affordability of mortgages. PJ, we're going to check in with you on this a little bit. But this is an interesting stat that Melissa pulled up. Historically, from 1985 to 2000, 21% of household income was dedicated to mortgage payments. And right here, first quarter of 2018, we're well below that number. About 4 points below the historical average over the last, 25 years or so. So that's interesting. So what does that mean? Well, even though prices are rising, inventory is tight, it's still relatively affordable compared to where we were from 1985 to the year 2000. And here's just a forecasted look at where things are headed as rates rise. And you can see, even if we get into the 7% rate mark, it's only a couple points higher than where that average was from 85 to 2000. So even if we get rates into the 6%, we're still, at a relatively affordable level for people. So let's get a little more granular and local. We're going to take a look here at Orange County, New York. Again, the mother's milk of all stats, the number of units being sold. You can see here the lines, red is 18, blue 17, green 16. Although it's a slowing pace, it's still at historical levels. on last month's update, I had mentioned that in our area, where the current number of homes are selling was equivalent to that of 2006, which was 1 year before the absolute peak of any market that we've ever seen in 2005. Actually, it was 1 year after. So the rate of sales that are happening is historically very high. This is a very hot market. So it's holding, it's steady. It's not, it's kind of, again, a mixed bag. Average price, we definitely had liftoff this year. You can see the average price was kind of, not really going up or coming down, but this year in 2018, clearly prices are rising. And I've always, as far as, for the last 15 years, I've been looking at stats every month, and I can tell you that price always lags number of units sold. In other words, units sold continues to increase, price doesn't quite get there, and then units sold starts to decrease and price doesn't quite follow it. There's usually at least a 6-month lag. So I found that there was almost a 2-year lag in average price as we came out of that downturn. So that's just interesting, but prices are definitely on the rise. This is another interesting stat here. And again, this is Orange County, New York. Homes that sold at 100% or more of last asking price. 40% of homes right now are selling at or above asking. That's a lot of bidding wars going on. That's reaching 50%. That's a super high level. That's an indicator of how hot the market is. Days on market, how long homes are selling, that continues to decline. Not as big of a variance from 16 to 17, but nonetheless continuing to decline there as well, which also shows a hot market. So on the other side of the border down in Jersey, let's take a look at Sussex County. Similar, right? We're looking at a mixed bag of units sold in Sussex County, New Jersey. Again, some months below, some months above. Average price, not quite seeing the liftoff that we did in Orange County, but nonetheless higher. Okay, I mean, you could argue that pretty much every month except for the first two have been at or higher than any of the previous 5 years. So that's a good mark, and you can see that there's quite a variance here in July. So things are looking up there in Sussex County as well. And homes that are selling at 100% or more of asking, so not quite as high as what we saw in New York, but within 5 percentage points. So 35% to let's say between 30 and 40% of homes are selling at or above asking. Days on market, again, similar trend, around the 90-day mark. Things are selling very quickly. So I already mentioned our guest panelists, but before we get into the panel here real quick, just note that next month we're actually changing it up. We're not doing the second Tuesday. I believe September 18th is the third Tuesday of the month, and we are changing the time of this to 2 p.m. And of course, all of these stats that I just showed and more can always be found at greenteamhq.com/housing market update. So enough about the promotion commercial interruption there. Let's get right to our panel. Karen,
yes.
You heard all the stats, all the information that I gave. You're the person with the boots on the ground. You're one of our top producers in New York and New Jersey. How do you feel it's going out there?
I feel that there are a lot of buyers that are moving both into Orange and Sussex County, and we have to rush and get the houses in. There are lots of bidding wars going on. It feels as if some of the flippers that we have in our area are doing less and asking for more, so that's a new trend. Usually they do a lot better job than I've seen lately, but currently the houses that we have on the market are unfinished, yet still on the market. That's scaring buyers away as opposed to making them want to bid on the house. And so we actually have houses that are for sale, not flipped, meaning outdated houses that are selling a lot higher than they should or would a few months ago.
That's interesting. So the takeaway, I guess, is that you're not necessarily seeing any signs of this market slowing down.
Not at all. It's the exact opposite. We have people that are still rushing. I have found that delays that we have, I have a lot of sales that should have gone through in July and are currently going into August. And these are delays that are being caused by whether it's the mortgage company that they're working with not Family First because they're phenomenal. I've actually had a client that I flipped to them and they closed in less than 3 weeks, which was phenomenal. I couldn't believe that they were able to do that. And that's definitely a testament to how well they work and what a well-oiled machine they are. But as far as the delays, they're being caused mostly by mortgages and people making silly decisions with their finances as opposed to anything else.
Yeah. And I think, one thing, in my opinion, PJ, will kind of transition this discussion over to you at this point, but one thing that I've been saying for a long time and why I feel that this market upturn, there's a few reasons why this upturn that we're seeing after that horrendous downturn that we went through stands the chance to have longevity, is because of how deep and how long the downturn was. So there was a lot of pent up demand and people didn't move for so long. So now it's going to take longer for those people to land. But I also think that the banks really cleaned up their balance sheets. I also feel that the programs tightened to a certain extent, that, banks are making money. There's a lot less defaults happening as opposed to what we saw the last time around with all the mortgage-backed securities, this, that, the other thing. So I feel like the banks are making money. They're in the game. They're not going away. And, I feel like, of course, everything that we have is related to how much money the banks are willing to lend. So your thoughts?
So personally, I think that the mortgage industry is doing good in which they are offering a lot more first-time homebuyer programs with as little as 3% down, USDA becoming very, very popular, especially in the Orange and Sussex County areas. I think what is also exactly in the trend that you're talking about is they are loosening up a bit and coming up with more portfolio loan products, personal products, and then using more of a common sense underwriting and ability to fund when looking at these borrowers. I think the trend is obviously leading to properties in that $200,000 to $300,000 price range now becoming so few and far between that they are now looking at different programs such as adjustable rates, less money down, interest only type payments. But that's a situation where the education and the information that you're giving them up front, making sure they're prepared for what that's going to be, is setting the forefront of everything that's going to come together throughout the process. I think it's very important to know what they are getting into when looking at those products and making sure that they are aware of where that's going to go.
Right. And I think to that point, PJ, the last downturn that we experienced, I think largely happened because the banks were not requiring people to have, quote unquote, much skin in the game, right? Zero down, stated loans. Everybody was lying about their income, and they were just jamming it through because of we're not going to get into why that is, because that's a political hot button. But needless to say, I guess my question to you is, do you see much of this no skin in the game lending coming back, or is it still a situation where the banks, people like yourself, have to scrutinize income, down payments, the full comprehensive financial situation of people before loans are going out? Because that's the thing that scares me, right? Is when it becomes too fast and loose. That's where we get ourselves into trouble. So give me some feedback on that.
So first, I think Fannie and Freddie are doing a great job with opening more of the common sense when I say that, where the people that truly should be able to expand themselves a little bit or, have a little bit more, risk to a point, they are analyzing that in a good way. However, they are still requiring that skin in the game. Like the no doc, the stated programs, I don't think they're going to come and start trending as much as they could have in the past with owner-occupied properties, second homes, because ultimately due to foreclosure laws and things beyond even just the mortgage industry, the banks are still protecting themselves where they're not letting that person put themselves underwater and making sure that that analysis is still done. Banks are now considering, LLC properties and things like that when looking at the qualifications of borrowers, because they saw what happened, in that 08 to, 10 range, where people were just giving up all of their, second homes and things like that. And that's what truly has hit part of Sussex and Orange County in there.
Sure.
Because a lot of this was those vacation homes, the lake homes for these communities. And now that's why the flippers are coming back in and you're seeing less of the inventory because that thing's moving out.
Right, right. Yeah, that's a good point. So, okay, that's good information. So unless anybody has anything else to say, well, let's go one more thing about from you, PJ.
Mhm.
Where do you see mortgage rates heading? I mean, the Fed's been raising short-term interest rates. I think they're going to continue to do that to stifle inflation. I don't think there's any question about that. And I don't necessarily see that as a bad thing because it was so low, it had to go up at some point. And I think that's not a bad thing. But where are mortgage rates? Where do you see them landing over the next 12 to 18 months?
So the next 12 to 18 months, I think we're going to probably be consistently in the fives through, most loan programs. I think we're definitely going to have at least one more raise, based off of short-term interest rates. Luckily, we missed that one a couple weeks ago.
Mhm.
But the market is truly doing a good thing where they're building it into where rates are. So you're not seeing those drastic changes like we saw in 16 in November and December, where you saw a difference in interest rates of almost a full percent in less than a 30-day period. You're now seeing it slowly trend in where it goes. The
Mhm.
scare from a mortgage side and probably an economist side is looking at how high that trend goes, obviously the inventory and what is out there. So making sure that the supply and the demand kind of balance each other out, because ultimately, if we're looking at 7% interest rates with less, houses that are not staying on the market less than 60 days, we're going to be in trouble at that point.
And from an affordability standpoint, yeah.
Exactly.
Yeah, and I think, if I'm a person who's maybe a first-time home buyer, and because I mean, so much of life is timing, right? And we can't control it. If you're a young professional that graduated college 4 or 5 years ago, and you've got money saved up, and you've been renting this whole time, and now it's time to buy because you just got married or whatever it might be.
Mm-hmm.
I think the takeaway is that if you buy now, I don't hold a crystal ball, nor does any of us here on the panel or anybody. But I think, the value of your home is not going to drop out like it did, 12, 14 years ago. I think, the pricing levels where we're at right now are pretty realistic to hold for some time in the future.
Absolutely.
And I think that, I would want to know if I'm a buyer, that's one of the big things I would want to know is, the asset that I'm purchasing now is going to be worth at least or more than what I pay for it now, 5, 10, 15 years if I have to relocate or something like that. So I think we're in a space right now where, it's a good time to buy. It's still a very good time to buy. Although it is a seller's market, it's still a good time to buy.
I couldn't agree more.
Yeah.
I think appraisals as well they're not allowing the appraisal inflation to come above where the market truly should be. So even though, sometimes you're dealing with those issues when looking at appraisals in that situation, it's better for the appraisers to be a little bit tight because that's going to keep the longevity of this strong market going on for that 12, 18, 24 months.
Yeah, that's a good point that I can definitely reflect. Overseeing 80 plus agents between two offices and being the person that a lot of people come to when there's complications and deals and this, that, the other thing. Appraisals have been challenging over the last 3 years, I would say.
Mm-hmm.
Although I would say that now that we're starting to see a steady trend of price increase, I think the appraisers are willing to go along that line that, okay, well, I don't have a comp that can substantiate exactly how much
Mm-hmm.
this property is selling for, but we're in an upward trending market, so I can make an allowance for that.
Correct.
And I think, a year and a half, 2 years ago, you could just see from those price charts that I had, it was up, it was down, it was a mixed bag. You couldn't really see where the market was going. So I think a lot of appraisers were a little bit leery to take a chance that this home is worth more than the one that just sold 3 months ago. But now I think that I'm not hearing a lot of appraisal issues because we are in an upward trending market and they're willing to take a chance on it. But to that point, there are still times where appraisers will not go along with some of the offers that are coming through.
Correct.
And I guess depending on where you are on which side of the fence, that could be either a good thing or a bad thing, you know?
Correct. It's sometimes, hurts the sellers, but, helps some of those buyers. And that's the thing that's protecting those first-time home buyers. So.
Yeah, and it is yet another control of the marketplace. It's not a bad lever to have. So that's good stuff. Okay, so Jeff, let's check in with Jeff Lobb from SparkTank Media. Very excited to have Jeff here. Jeff's a big deal in my world, in my view. He's a marketing guy. He's extremely knowledgeable, and I'm just kind of giddy to have him here today. So welcome, Jeff.
Oh, thank you, man. I appreciate it.
So Jeff, I am so interested to hear from you. I mean, I read Inman News. I get all of the scary emails. They're great. They're great at fear mongering, but that's what sells news. But I also am smart enough to recognize that there's a lot of truth in things that are coming through. And I've also, I'm proud to say that I've now been in this business for 15 years. And so I've seen huge swings, and I've seen different business models come in and out. And, I want to have a quick discussion with you, 10, 15 minutes here about, kind of the future of us service providers in the industry, because as technology sinks its teeth into so many industries, I mean, we've all known, the common person understands what Amazon has done. I mean,
sure.
Look at what happened at Toys R Us and all these other retailers. So, are realtors going by way of, Toys R Us? Is technology going to replace realtors? What do you have to say about that?
Well, I don't see that happening anytime soon. Let's just be frank. I mean, while all the buzz and, let's face it, the words disruption and all these buzzwords, they sell media. And there is a bunch of stuff happening at higher levels, and I'll discuss maybe a bigger 30,000-foot view first and kind of bring it down to a smaller level. But the real estate agent is not going away anytime soon for this one simple reason, is there's too many moving parts in a transaction. And the most important part is it's still a very emotional part of a transaction. It's a very emotional thing. Technology cannot handle and respond to those things yet. So let's talk the disruption word that we talked about earlier, or you mentioned earlier. Coming out of Inman, San Francisco, we were just having big conversations there. All that's happening is more brands are trying to change the way we do our business. They're trying to make it better, faster, more tech, maybe sometimes going the opposite, going more niche, if you want to say it that way. So the big talk recently coming out of the West Coast Inman conference has been the new companies that are coming into play. For example, the Compasses of the world, the Redfin models, the Purple Bricks that's entering into the flat fee space, which we've seen come and go in the past 20 years, those models come and go. So I think the word disruption is simply new people coming into the space trying to change and elevate what we do. But at the same time, we've seen a little bit of an extreme go to that niche where we've seen some very large teams functioning and leaving major brands saying, I could do this better by myself,
right,
without the big brand box. So a lot of change is happening in those categories from that level. When it comes to the market, fortunately, we do a lot of coaching with teams and agents across the country. So I see pockets. There are pockets of just things that were never normal. So for example, one or two teams that I coach had homes that are in the $800,000 range, selling multiple offers in 2 to 3 days for 5 years straight. Well, now that particular pocket is, and then you might say, oh, geez, poor them, right? Like, oh, that's such a terrible problem. Challenge is when the day's on market and people aren't making those offers, and instead of getting 800, now they're getting bids at 750, and it's taking 3-5 weeks to get activity. It seems like the sky is falling in their world. And the big problem, and where people are capitalizing, is they've budgeted their businesses and grew their overhead and everything to meet those cash flow demands. And now when the market's shifting to what I call a balanced market, it's not falling. Like, that was never normal to begin with. That was not normal. They just saw it as the norm. Now they're realizing, I got this staff, I've got these teams, I've got this overhead and marketing and expense, and now things are taking longer to close, which is cash flow challenges. So that stuff is balancing in different markets. I've even heard people go to the extreme and say, the market sucks. And I'm talking, it took 5 weeks to get an $800,000 home sold. That's like
that's called immaturity.
Right. Like, you got to stop it. Like, stop. And
Yeah.
there's a lot of that going on. There's a lot of that. So to bring this local, you know, there's only like, if you open it, to me, what motivates me is look at inventory every morning. You know, if I were in your market, which I'm not too far from your market, but let's just say I look at the market and I see, okay, there's, you know, 500 listings on the market. What challenges me and gets me up every day is, out of those 500, how many did I get? And if I look and I only got 2, well, guess what? There's a lot of work to be done. It's the business is a marathon, but the day-to-day is a race. And it's a competitive race. And I don't think we have enough competitive drive to do the hard work to go get those listings the way we should be. Somebody else is getting them, someone less qualified than me, someone that has a better relationship than me. But to say that the business is slow, it should be never, ever slow. It's, here's the 500 homes that are on the market. How are you going to get more of them? Because every day more come on, and every day more get sold. And somebody's doing those transactions and getting those listings, and those buyers are driven to it. It's just a matter of where do you stand in that pie. And sometimes if that's not a kick in the seat enough to say, maybe I need to level up my game. Maybe I need to be a better marketer, more aggressive prospector, and all that stuff. And that's where the challenges come in, is we're not doing enough of the work, because it still is work. All the technology in the world is only here to help us, make us work faster and smarter, but we still got to do the work. And I think we're not still there with the discipline to do that.
Yeah, that's good. That's good information. And, you know, I guess just a couple of points that I would add to bring it, I guess, back to a 30,000 foot view about, you know, the broader perspective about where we as realtors stand and what our future holds. Just a simple analogy. Today is my wife's 40th birthday, and yesterday we bought her a car for her birthday.
Yeah.
And we didn't go online and click buy a car. And I would say that cars are far more of a commodity than homes are. You know, much more in line, standard features, a faster transaction. I mean, we got it done in a day, right?
Yep.
But man, it took all day. And I tell you what, we needed a salesperson and we needed that finance person in the dealership to get it done. Otherwise, it wouldn't have gotten done. So, you know, I think a stat that I recently heard from a company that was doing a pitch for some funding, they're in the travel agent space. Travel agents, there are more travel agents now than there were in the year 2000. Imagine that. Travel agents are making a comeback.
Yep.
Why? Because, all right, you know, there's all these tools and all this information online, but man, it takes a lot of time, you know, and who's got the time to spend to do all this stuff and research everything? Geez, let me just hire somebody to do it. And I think, you know, we've had this explosion of information, explosion of technology, but at the end of the day, it's time. And are most people going to want to spend the amount of time that it actually takes to properly get the most amount of money to sell their home, or the, you know, to negotiate it and do it the right way to buy their home, when they only do it maybe once, twice, 3 times in a lifetime?
Right.
You know, and I say no. I think that us real estate professionals will always be around because we're needed, because we provide an absolute important piece to the puzzle. And I would say one last thing. I think it's very clear how important the housing market is to the overall U.S. and global economy. Make no mistake about it, this economy is revving, I think, largely because the housing market is healing, is coming back, and is back and seen, you know?
Yep.
And that has global ramifications and everything. So I think, to your point, Jeff, us, the agents are critical to the health of the U.S. economy, so on and so forth. So
yeah, and look, if you say, you know, is the Amazon going to get into the real estate business? My gut, sure, they'll get into the mortgage business. Will Facebook get into a real estate marketplace? Sure, they're kind of there now, and will they blow that up? Maybe. But you know what? That doesn't still end the process. As you said, as we get into more of a fast-paced lifestyle, we're finding that we want, and just think about the real estate agents at large. There's times where people are saying right now, like, hey, I'm so busy, I need someone to do my stuff for me. I need that work. So while you got this, I hate to use the word, millennial because it doesn't really exist in my mind, but they use that to categorize the younger generation. Well, they might say, hey, I just need someone to open the door for me. I did all my research. You know what? They still don't really know the process, the value of equity, the things they need to go through home inspections. They most think they know what they think they know. The challenge is, and I've learned this from trying to hire a younger generation, and here's something I learned recently. I said, okay, I need some help here in my offices. So let me find some younger, more social media savvy people out of college. And while they were super smart about, and this is not making an assessment of all, let's just clarify for those listening, super smart at the platforms themselves and could engage better and faster than anybody, they didn't know how to market. They didn't know how to run a business. They didn't know the business skills of marketing. They didn't even have the motivation to be like driven to it. So they've got super fine, minute skill sets, but they lack others. So when it comes to real estate, put them in a transaction, they may do it, but I think their first couple experiences might be a hot mess if they don't do it with the right level of experience. So, you know, the big picture is some of these companies are coming into play trying to acquire agents and market share. That's what they're trying to do. Compass will tell you straight out they're buying market share. Others are trying to come in and change the way technology is driven. You still need the people to execute the transactions and deal with the emotional process of a sale, period. Too many moving parts.
And there it is. There it is. We humans are complicated beings, you know, and it just takes a human to be able to navigate this process of buying a home. So, all right. So you and I think, are on the same line, on the same page. I guess, you know, perhaps we're a little bit slanted in our view because we make our living off of, you know, the real estate transaction and being involved with agents. And so obviously we're huge fans of real estate agents. But, you know, I can honestly say that I've been trying to be extremely objective over the last, you know, 6 to 12 months of me absorbing all of this negativity and everything coming out, because I am so invested, and I don't want to be a person that's foolishly continuing to invest in an entrepreneur continuing to invest in something that's going to evaporate. But my analysis is that is just not the case, and that we should continue to invest in real estate agents and our industry, because it is a needed timeless type of thing.
Agree.
Okay, so I think that's a wrap. I think that's a record 33 minutes. Pretty good, Melissa, right? We've been running 45 to 50 minutes. So does anybody from our panel have any last minute comments, questions, or concerns? Going once, going twice. Okay, 3 times. So we're going to finish at this point. I thank everybody for joining us. Come again next month. I showed the date. Melissa, what's the date and time? I think it's September 18th at 2 p.m. She's shaking her head. Yes. Okay. So September 18th, 2 p.m. It's a Tuesday afternoon. And go to our website, greenteamhq.com/HMU. And you can always register in advance for the webinars. You'll be kept in touch. You can fill out a form so you can be emailed updates, so on and so forth. Thanks everybody for being here. Take care.
Thank you.